Welcome everyone to our Stearns Financial live chat for Friday morning. And we have with us today two of our wealth managers, both chartered financial analysts, highest designation in the investment area, and they are both research affiliates with our investment committee. So they do a lot of work in a lot of different areas for researching investment ideas. We have Dax Dixson and Jason Croy. Today we're doing something a little different. We're going off the beaten path. It's not terribly deep into the woods of coronavirus pandemic land, but it's things that maybe haven't gotten as much attention in the media, things that we think are interesting and may create some near-term issues or longer-term issues of how will the middle game and end game of the pandemic play out. So we're going to jump right in. So there have been quite a few silver linings of the coronavirus pandemic that we have highlighted in our recent chats and our live chats. The telemedicine one, if you missed that, that is available on our YouTube channel and via replay, was very interesting, and certainly some of our guests there had suggested we may be seeing 10 years of innovation in 1 year. And so that whole telemedicine trend will be interesting. We will be doing later this month a special Future of Healthcare Zoomcast that will dig into this and other areas a little deeper. Vaccine and treatment research leaping forward. We featured some of that in our written and live chat from last week, and we're going to talk about that a little bit more today. And then an area that, again, off the beaten path, infrastructure repairs, moving ahead faster and under budget, which those words faster and under budget almost never go with infrastructure repairs. And so Los Angeles has reported that they've had cost savings of 25 to 35%, repaving roads, planting trees, and repairing sidewalks. And similar kinds of things are coming out of both cities and states and countries all around the world. So we're not so sure how long that trend's going to continue in the United States, because one of the things that we talked about in our last week's chat was the fact that the next battle is going to be around helping states with their budgets. And so some of these infrastructure repair funds may run out in the next month or two. But at least for right now, a bit of a silver lining. So let's get into the vaccine area. And so Dax, there's currently a number of trials going underway for different treatments, different vaccines, and we highlighted some of that in our written chat from a week ago. Talk to us about what you're seeing in both the challenges and the opportunity side.
Great. Thank you, Dennis. It's a pleasure to join you here on the big screen. First, I wanted to say that the global health response to the coronavirus has been extraordinary, as we noted in our written chat last week. You know, within the clinical trial space, the headlines have focused on the treatments and vaccines for the coronavirus, many of which have entered the clinical trial at rapid rates. Notably, the Gates Foundation has been a leader in developing, manufacturing, as well as distributing potential treatments and vaccines for the coronavirus. However, there are other challenges being presented to clinical trials that aren't involved with coronavirus. As you can see, participation is down anywhere from 50 to 80% compared to 2019 within clinical trials. Many potential participants are in the most at-risk areas within the population, and so as you can imagine, they're very hesitant to be a participant if they have to go on site to some of these clinical trials. On the other side of the coin, you have delays in testing for trials that were underway before the coronavirus actually started. And so I think that could delay some of the treatments and drugs and vaccines that are currently being tested. That could be delayed for getting them to market for 12 to 18 months.
Well, so Dax, clinical trials in general are an important part of healthcare, drug development, treatment development, beyond the whole coronavirus piece. I mean, what kind of impacts may this have going forward?
Yeah, I do believe there are a number of opportunities that this environment has presented to us. I think there's some parallels to, in your opening remarks, you were talking about developments within telemedicine. And I do believe there are opportunities that parallel that within the clinical trial space. Out of necessity, clinical trials are adapting technology that they have been hesitant to dive into in the past, including some off-site testing. So distance testing of some of the participants within existing trial and an increased use of technology within that space. And also on the regulatory side, regulators have been more flexible and pragmatic with some of the solutions that they're offering trials that are currently underway, including delayed testing and reworking the framework of those clinical trials. So I do believe moving forward, there's some lessons that are going to be learned from the clinical trial space and how they've adapted to this coronavirus environment that may prove very valuable to future drug development and shorten the time to market for a lot of these very important drugs out there.
Okay, thank you. Great. So let's shift gears now to another area that hasn't been quite as much in the news, but the effect of the pandemic on retirement plans in various states around the country. Jason, tell us about that.
Sure. So this is obviously a big topic, and many of the discussion angles we could take are beyond the scope of this particular webcast. But we've all seen stories in recent years about the size of unfunded pension and retirement benefits across multiple states. And so given the breadth and the depth of this pandemic, we wanted to take a look at how state programs may be affected. And so this particular illustration we have up just gives a good visual of that. But certainly keep in mind, it does have a number of assumptions built into it. And again, we really just wanted to highlight the degree that the pandemic is having on the public sector. And so let me just explain the graph. The first point I'll make is that those yellow highlighted states at the bottom are really a sampling of locations where our clients are located. And so we may not have caught everyone, but hopefully it's a good representation. The analysis we're looking at was done by JP Morgan using some very recent data from back in April from Moody's Analytic Group. You may have heard of Moody's as the bond rating agency. And so on this slide, that vertical axis is the estimated percentage of unfunded state obligations as a percent of state revenue. So state obligations divided by state revenue. And those obligations are including, pension payments as well as things like retiree healthcare benefits. That gray bar is effectively what states are currently paying out using their latest actuarial and investment return assumptions. On top of that, that blue bar, JP Morgan tries to argue that investment returns looking forward may be lower than where they have been historically. And I mean, that's an area you've heard us at FSG say regarding a number of asset classes in recent years, and something that we are mindful of when we're designing our portfolios. In this case, JP Morgan tries to illustrate that the unfunded obligations may in fact be higher than originally thought, just due to lower asset growth potentially in the years ahead. And then finally, that red bar is what we really wanted to focus on, and that's the impact of COVID-19 on the funded status of some of these programs. And so the analysis really looked at two variables. It looked at the revenue that's being taken in from states and the impact of that given the COVID-19 economic shutdowns, and then the impact of portfolio returns. And so, given the high rates of unemployment, many of you probably saw the release this morning of April's unemployment figure, which was an astronomical 15%. And when you look at, break it down further and look at people who may be underemployed, it gets well above, in the low 20s. States are certainly going to bring in a reduced amount of revenue this year, potentially next year as well, which is just going to put further pressure on their financial systems. And then on the portfolio side, just like each of us have felt the heightened volatility this year from the market, the pension plans and their investment portfolios have felt that volatility as well. Over the last several decades, a lot of pension funds have increasingly invested in riskier assets. And so they've really felt the brunt of that volatility this year. And so all that to say is that there's a tough road ahead for several states, for their treasurers and their legislatures. And unfortunately, it's gotten a little bit tougher. It's worth noting that not so unsurprisingly, that the size of that red bar, or the degree that COVID-19 has had, is really larger for those states that had the largest unfunded obligations coming into the crisis. And so while a few of those numbers on the left side of the screen are pretty staggering, it's also, I thought it was fairly encouraging that, many states across the country seem to have, have manageable obligation levels. And so while there's a handful of states that are going to have to deal with this issue a little bit sooner and are feeling the brunt of the COVID-19 a little heavier on their shoulders, a lot of states are being able to deal with it and bounce back, in lockstep. So.
Yeah, and I know that a few of our clients in those states to the far left are not particularly thrilled about some of the things that are going on within their own state legislatures and how they're dealing with budgets, but we won't get into that topic today. So from a point of view of being manageable, this particular area has popped up in the last 10 years, at different times by people saying, well, someday this has to come home to roost. And when it does, watch out. It's sort of like student debt. Everybody keeps saying, watch out when student debt. And then, it never does come home to roost, or at least it hasn't so far. And so what do you think manageable means in the state pension space?
Well, I think, to the extent that that the treasurer's offices and the legislatures are able to keep their relative outstanding obligations in a relatively low percentage of those revenues that they have coming in, and to the extent that they're able to continue to increase those revenues and increase their tax base, they're going to be able to continue to meet those payments without making material adjustments in the near term. And so while, again, some states are going to have to deal with this quicker than others, we do think that coming out on the backside of this, hopefully the economy will be stronger, and there will be a lot of that tax revenue will bounce back and not be a permanent loss, but just a little bit of a delay.
Okay. Well, and there's a whole nother side to this particular issue that is heated up here lately, the debate over whether some states should be able to go bankrupt or not. Again, we're not going to try to get into that today because that would be probably an hour-long chat of the arguments on both sides of that equation. But for those of you who want to dig deeper in that, I would suggest Google as a great resource. So Jason, you had mentioned the unemployment rate that came out today being sky high. Dig into that a little bit for us.
Sure. So if you want to move to that next slide, one other area that we looked at is that we've seen a lot of headlines around unemployment was expected to really spike in April, and the number we saw this morning certainly confirmed that it did. And so we wanted to look at what areas of the economy are most likely to experience that spike and experience that downdraft more so than others. And so you can see that there's a clear divide down the middle, and let me just explain what we're looking at. That vertical axis along the left shows the percentage of each industry that has been laid off in the last couple of months due to the economic shutdowns. Those blue circles or bubbles represent a different industry, and you can see they're labeled. And then the size of the bubble shows how large that industry is relative to the workforce of the US. And so if you were able to add all of those bubbles up or stack them on top of each other, it would represent the US workforce. And then that horizontal axis at the bottom shows the average weekly earnings of workers in those industries. And so what's clear from the chart, and this is somewhat intuitive, is that workers in the lower earning industries are unfortunately the ones that have been hit the hardest and have seen the highest percentage of layoffs. When you think about that typical leisure or retail worker, think about any kind of recreational activities or sporting events or, movie theaters, concerts, certainly the tourism industry, they get wrapped into these couple of groups. And you often have a lot of hourly workers that have experienced a much higher displacement. Those bubbles on the right side have a lot of roles that perhaps are more salaried in nature. And while you've seen stories of potential salary reductions or changes in compensation schemes, a lot of the folks employed in those industries have had stickier positions that have been able to utilize technology to really remain viable going concerns throughout this. And so as we look into those unemployment numbers, and we'll get a little bit more detail as we can dig into those reports that came out this morning, haven't had a chance to read all the data yet, you can see that there really is a big divide across the country based on what industries people are employed in.
Yeah, I think there's some interesting texture here, which we dig into a little bit in our written chat that everyone will get later today. And that is around those folks in this graph to the right-hand side, typically with larger incomes, not being hit as hard. That has real implications for a number of companies and how they will come out the back end of the pandemic. It also has implications for things like real estate, multifamily housing. Which people do you have in your apartment complex? Are they paying their rent? Can they pay their rent? And so the folks on the right-hand side are in a much better place to be able to do that, spend money when they're comfortable spending money. And again, there's a lot of folks, I'm sure, on the right-hand side who are still holding their breath to a degree about whether their job will be furloughed or cut back or other possibilities. I was talking to a pretty significant lawyer in the commercial space the other day, and he was talking, and they have lawyers in their firm all over the country, and he said their productivity in the last 30 days has been off the charts. And he said, but I don't think it's because we're not spending as much time chatting with each other and, we're not spending the commute time. He said that's probably some of it. He said, but some of it is we want to make sure we're indispensable. And none of us feel like we are completely safe in the pandemic. So a lot of the people that he talks to around the country in their law firm are working their rear ends off to make sure that they're indispensable and will not be part of a future furlough or layoff or something else. So yeah, interesting stuff. All right, well, so let's go to that next chart. So what are we looking at here, Jason?
Yeah, so one of the other angles we wanted to show that piggybacks on the chart before it is really just seeing how those lower income areas have been hit geographically. And you can, really look at the four corners of the country, and, the darker shades have had more layoffs and the lighter shades have had less layoffs. Don't necessarily need to focus on the words along the right-hand side. I know it's a little bit small print, maybe difficult to read. But, looking up in the Seattle area where the U.S. pandemic really started and then it trickled down into Southern California, you're still seeing a lot of meaningful displacement there. Over to the Southeast where, our neighbors just south of us and outside of Atlanta and Southern Louisiana and Florida have also felt the real impact of this. And you think about some of the tourism industries in those areas, and then certainly in the Northeast, with New York, but even like Pennsylvania and Michigan, where you have a lot of manufacturing, a lot of those workers have also really felt the brunt of this. There is some light at the end of the tunnel, or it seems that there could be. In North Carolina here, we're beginning to, this afternoon actually, implement phase one of a 3-stage process to potentially reopen our state. other states have, taken different timelines, and the timing of when operations are able to open up are debatable. But again, the people who are likely to benefit the most are those lower income areas and lower income industries where the need may be the greatest. And so it's a very thin tightrope from a policy standpoint to walk. But thinking about the implications for how we position portfolios and how we, the potential for the economic recovery ahead. If those industries that have been hit the hardest are able to start to get back on their feet, there's certainly going to be reduced capacity and a lot of restrictions placed on any reopenings that take place. And social distancing is certainly going to be the mantra for all of us in the months ahead. But to the extent that some of those industries that have been hit the hardest and that have caused that unemployment rate to really spike, if they're able to start getting back on their feet, that's going to have big implications for how deep the recessionary environment is, how long it lasts, and the path that we take to recovery. In previous chats, we've talked about that V shape or U shape or, W, L, or some other alphabet recovery that we may have. But it's all going to have implications for how we come through this on the economic side. And so, who knows, consumers may find some pretty attractive discounts or good experiences in coming weeks if all this works out in a positive manner. I don't know if anyone's open to getting on a cruise ship anytime soon, but if you are, you could get a good bargain in the next couple of weeks.
Well, that's right. And I mean, that actually gets into what kind of impact on certain trade or industries may be happening in the future for either one of you, Jason or Dax. Some thoughts on that?
Yeah, I mean, some industries, like we said, have certainly been hit the hardest, and some you think are going to bounce back quicker and could have good implications for how we position assets or opportunities we may be able to take for more growth-oriented clients. It's certainly part of the conversation we're having internally all the time, and hopefully having those conversations with clients as we speak with you all. I don't know if you have any other color you want to add to that, Dax, but.
Yeah, I think that, mother is the necessity of invention. And when you enter in a time like this, I do believe there were trends underway previous to this time that are just being accelerated right now. And I think a big one of those is automation. And as whether it's working from home or even some more physical locations, they're going to move more towards automation and things like that moving forward, because they have to at this point. Because of dealing with the global pandemic that we have underway.
Well, yeah, and that really kind of gets into this McKinsey chart, and it's a little busy. This chart and some of these other charts will actually be in our written chat for those of you who want to study them more. And this one has a lot going on with some different scenarios that McKinsey looked at, but this was pre-coronavirus, and we have it from a McKinsey partner. They are working on updating a lot of this. But the interesting thing here, they were looking out to 2030 about what the impact would be of jobs. And many of you remember our SFG Trends report a few years back on the future of jobs and how jobs will be changing. Well, that has not something new. I mean, it's been happening in the United States to a certain extent all around the world, but the United States has been leaning into changing jobs on a regular basis and changing the nature of jobs. And so what this is showing is the midpoint scenario. Well, first of all, in the upper right, 6 of 10 current occupations have more than 30% of activities that are technically able to be automated. And so that says that maybe a job doesn't go away, but a portion of a job goes away. And then you look at the potentially displaced work. Now, this is global, so not just the United States. And the midpoint of their scenarios is by 2030, 15%, 400 million jobs could be displaced by automation. and it could go as high as 30. It could be as low as almost zero, which 10 million, if you're one of those 10 million, you don't feel like it's zero. And then workforce that would need to change occupational category by adoption scenario, 3% midpoint. And so that's kind of an interesting one that says that maybe a lot of knowledge worker economy jobs are relatively safe. Now, again, for those of you who remember our trends report from a few years back, what it showed is that it was many of the non-knowledge economy jobs that may be most at risk over the next 5 to 10 years. And so one of the interesting things right down at the bottom, you can see, in addition, a 2030 workforce of 2.66 billion. Now this is worldwide. 8 to 9% will be in new occupations, ones that don't even exist today. Well, so the punchline of all this is that what we hear from McKinsey and actually some others, all these trends are going to be accelerating, back to Dax's point, that what may take 10 years in a normal environment, maybe it only takes 5 years in this kind of environment. And that's good news for many, and it suggests that just like that lawyer that I mentioned, make sure that you are indispensable in whatever it is that you do as a job or career, and that you are updating your skills on a regular basis so that you don't someday find yourself on the wrong end of this particular trend. So we're running a little bit low on time. We've interjected a couple of the audience questions. I think one of the things we'd love to end the note on is some of the positive things that are going on out in the world. And we've tried to sprinkle a few of those into our chats. Dax, why don't you talk to us about some of the things they're doing for feeding children and some of the other issues that are out there?
Absolutely. And so when you approached us, Dennis, to join the chat this week, one thing I was just thinking about Positive Patty here in Chapel Hill and trying to interject some positivity to some of the challenging environment that we're seeing out there. So I looked across and looked at a lot of the local responses in the nation right now. And, I was inspired by a number of stories, and then I found one in my backyard. So I'm a resident of downtown Durham, and in North Carolina, there's about 900,000 kids right now who are participating in free and reduced breakfast and lunch during the school year. So whenever schools did shut down, they lost access to food. And, a lot of their families come from areas within the economy and work in industries, as Jason alluded to, that are in the lower income that are most impacted by some of the shutting down of the economy over the last couple of months. So I thought that this was a really innovative solution that pretty much popped up overnight. It's called Durham Feast, and it's a partnership between Durham County schools, local restaurants, as well as citizens in Durham. And what they do is they take federal reimbursement dollars, county funds, and community donations that would have otherwise been allocated to the school systems for free and reduced lunches. And then they use that money to support local farms and restaurants. So they'll go to a local farm to get food and whatnot, and they go to local restaurants such as Dashi, Vin Rouge, Durham Hotel, Mateo, a lot of restaurants that I would otherwise enjoy when the economy was open. And those restaurants were able to stay open in a limited capacity and provide some income for people, as well as make meals and ingredients for those children and families that were displaced during the coronavirus and no longer have access to the nutritious meals that they had when they were in school. So I thought this is a really positive thing that has happened. It's not necessarily the technological innovation that we speak about in our chats and earlier in this one. However, it's just good old backyard innovation to kind of step up overnight to provide something within the community that's very needed at this time. So I thought that was one positive thing that did come from it, is that community involvement with Durham Feast, with both restaurants as well as individuals. And if anybody listening and any of our clients have similar stories that are going on about their backyards, that we'd certainly love to hear those as well.
Yeah, thank you, Dax. We are hearing on almost a daily basis from different parts of the country, clients and people that we network with, that these kinds of things are going on. And one of the regular things we hear is that organizations that normally collaborate, but maybe not at a really high level,
Mhm.
and who don't move fast, who are like aircraft carriers, that they're moving very slowly, are moving pretty quickly for them. I've heard the word light speed a few times for them, are moving pretty quickly to come up with these kinds of things. So again, another silver lining of a pandemic. It is kind of unfortunate we have to have a pandemic to make that speed of innovation happen, but it's a good thing. And particularly, we're trying to lean in at SFG for helping many of the children that don't have good meals, and as a result of the whole crisis. So very important one. So we are out of time. I will remind everyone that this has been recorded and that it will be available on our SFG YouTube channel or via the email with the recording that usually comes out on the following Monday. Again, I want to thank Dax and Jason for leaning in on this topic today on some of the less beaten track of things to think about in the pandemic. And for this afternoon, we have Mark Sanborn as our Interesting People and Interesting Times speaker for our 4 p.m. Eastern Time chat. Would definitely recommend that. Mark was awarded top 5 leadership gurus last year, 2019, in the world, not just in the US, and has written a number of books. Fabulous speaker, fabulous thinker, and has a number of interesting ideas to share with us this afternoon about the middle game, end game, and the after game of the pandemic. So again, on behalf of everyone at SFG, stay well. We hope you have a wonderful weekend. Thank you.